Welcome back. In Lesson 1, we learned what a financial market is. Today, we're zooming out, way out. We're going to look at the entire global financial system and answer a question every beginner asks eventually. Who actually moves the market? Is it me clicking buy and sell? Is it some big mysterious force? By the end of this lesson, you'll know exactly who's really behind the moves you see on your chart. Here's what we're covering today: how countries, governments, and central banks affect the markets you trade. How currencies, stocks, gold, and oil react when something happens in the world. Why interest rates and economic reports actually matter to your trades. How news and uncertainty create the price movement you see every day. And by the end, what all of this actually means for you personally as a trader. Don't worry if some of these words sound technical right now. I'm going to explain every single one with a real example, like I'm talking to a friend who's never touched this stuff before. Let's start simple. The whole world runs on trade. Countries buy and sell things from each other constantly, and this creates a massive flow of money between currencies. Here's an example. Europe sells machinery, like factory equipment, to the United States. The US pays in dollars, but the European company needs euros to pay its workers back home, so those dollars get converted into euros. Here's another one. The US needs lumber, wood for construction. They import it from Canada and pay in Canadian dollars. That gets exchanged back into US dollars on the other side. And one more. China makes electronics, phones, laptops, that kind of thing, and sells them to the US. China receives US dollars, then converts those into their own currency, the yuan. Now, here's why this matters to you as a trader. Every single one of these transactions is happening thousands of times a day, all over the world. And every time money gets converted from one currency to another, it nudges the price of that currency just a little. Multiply that by millions of transactions, and you start to see why currencies move the way they do. It's not just countries. Companies do this too, and you've definitely heard of these ones. Apple sells iPhones in Europe. They receive euros for those sales and then convert that money back into US dollars because that's the currency Apple actually operates in. Tesla exports cars to China. They get paid in Chinese yuan and again convert it back to dollars. Here's the simple way to think about it. When Apple makes a lot of money selling iPhones overseas, that's good news for Apple's stock price. But it's also a tiny ripple in the currency markets because all that foreign money is getting converted. Big companies operating globally are constantly creating these ripples, and ripples from thousands of companies added together become waves you can actually see on a chart. Now let's talk about a word you've probably heard 100 times, but maybe never had explained simply. Inflation. Here's the simplest way to understand it. Inflation means your money loses value. Things cost more over time. Let me give you an example you can actually feel. Say your favorite sandwich cost $1 last year. This year, that same sandwich costs $1.30. Nothing about the sandwich changed. It's the same bread, same ingredients. What changed is the value of your money. That difference, that creeping increase in prices, is inflation. So why does this happen? There are a few reasons. First, more money in the economy. During COVID, for example, central banks printed huge amounts of money to support people and businesses. When there's suddenly more money floating around chasing the same amount of goods, prices go up. Second, high demand, low supply. Think about it like this. If everyone suddenly wants to buy a car, but car factories can't make enough of them, sellers raise their prices because they know people will still pay. Third, rising production costs. If oil, wages, or raw materials get more expensive, companies pass that cost on to you, the customer. And fourth, global events. A war or supply chain problems can make shipping and importing goods more expensive, and that pushes prices up almost everywhere at once. Once you understand inflation, half of what central banks do will suddenly make a lot more sense. Let's talk about the most powerful currency in the world, the US dollar. Here's why it matters so much. The US dollar is used in over 80% of international transactions. Most commodities, oil, gold, wheat, coffee, are priced in dollars, no matter which country you're in. Countries around the world hold US dollar reserves just to be able to import goods and pay off debts. So think about it this way. Imagine the dollar is like the main language of global trade. Even if two countries don't speak English at all, when it comes to money, they're often still using dollars to do business with each other. This means when the dollar gets stronger or weaker, it sends ripples through almost every market on Earth. A rising dollar can actually hurt emerging market countries and push commodity prices down. A falling dollar can boost global trade, but it also increases the risk of inflation. So here's a question. If the dollar is this powerful, who's actually in control of it? The answer is the US Federal Reserve, often just called the Fed. Think of the Fed like the captain steering a massive ship. They don't control everything happening in the ocean, but they absolutely control the direction of the ship through the levers they pull, mainly interest rates and how much money is in the system. If you've ever heard a trader say, "The Fed is meeting this week," and get excited or nervous about it, now you know why. The Fed's decisions can move the entire market in a single sentence. The Fed isn't alone. Almost every country has its own central bank. You've got the US Federal Reserve, the European Central Bank, the Bank of Canada, and many more around the world. Their job, in simple terms, is to manage the country's economy. They try to control inflation, support employment so people have jobs, and stabilize the currency and overall economic growth. To do this, they use a few main tools. Interest rate adjustments, buying or selling government bonds, which we'll explain in a second, and changing how much money banks are required to keep in reserve. I know these sound technical right now. Let's break each one down individually with simple examples. The first tool is interest rates, and honestly, this is the one you'll hear about the most as a trader. Think of it simply. Interest rates make borrowing money easier or harder. Here's an example to make this real. Imagine you want to take a loan to buy a car. If interest rates are low, that loan is cheap. You'll pay less extra on top of what you borrowed, so you're more likely to go ahead and buy that car. Now imagine interest rates are high. That same loan suddenly costs a lot more in interest. You might decide to wait or not buy the car at all. Multiply this by millions of people and companies making decisions like this every day. When rates go down, borrowing is cheap. People spend more and the economy speeds up. When rates go up, borrowing is expensive. People pull back and the economy slows down. And this directly affects currencies, stocks, gold, and oil, which is exactly why every trader watches interest rate decisions so closely. The second tool sounds complicated, but really isn't. It's called quantitative easing, or QE, and its opposite, quantitative tightening, or QT. Think of it like this. QE is when the central bank basically injects more money into the economy by buying up government bonds. Imagine the economy is a balloon that's losing air. QE is like someone blowing more air back into it, encouraging growth. QT is the opposite. The central bank sells those bonds back, pulling money out of the system, like slowly letting air out of that balloon on purpose to cool things down. Central banks usually use QE when interest rates are already very low, but the economy still needs more help. The third tool is reserve requirements, and this one's actually pretty intuitive once you hear the example. Here's the idea. Central banks tell regular banks how much money they're required to hold on to instead of lending out. Imagine a bank as a person with $100. If the rule says they only need to keep $10 and can lend out the rest, that's $90 going out into the economy as loans. But if the rule says they need to keep $50, only $50 goes out as loans. So, low reserve requirements mean banks can lend more and the economy grows faster. High reserve requirements mean banks lend less and growth slows down. This tool isn't used as often these days, but it's still good to understand because you'll come across it in financial news from time to time. Now let's put all these tools together into two big strategies central banks choose between. The first is called expansionary policy. Think of the word expand. They're trying to expand or grow the economy. Here's what happens. Interest rates go down, so borrowing is cheaper. Banks lend more, so businesses can invest and grow. Regular people borrow and spend more too. And stock markets often rise because everyone feels more optimistic about the economy. Central banks usually do this when the economy is slow or struggling and they want to give it a boost, like pressing the gas pedal. The second strategy is the opposite, contractionary policy. Think contract, meaning to shrink or slow down. Here's what happens. Interest rates go up, so borrowing becomes expensive. People and companies borrow and spend less. This slows down inflation and cools off an economy that might be growing too fast, too recklessly. Stock markets may actually fall during this, but the currency could get stronger. Think of it like pressing the brake pedal instead of the gas. Sometimes the economy needs to slow down on purpose so it doesn't overheat. Now let's talk about something you'll see constantly if you follow trading news: economic reports. First, jobs reports, also called unemployment data. If more people have jobs, that signals a strong economy, and the central bank might raise interest rates to keep things from overheating. When that happens, the dollar tends to rise, while stocks and gold tend to fall. If fewer people have jobs, that signals a slowdown, which might lead to rate cuts. In that case, the dollar tends to fall, and stocks and gold tend to rise. Second, inflation data, often called CPI. If inflation is higher than expected, a rate hike becomes more likely, so the dollar goes up while stocks and gold tend to go down. If inflation is lower than expected, rate cuts become more likely, so the dollar falls while stocks and gold rise. I know this feels like a lot of if this, then that. Don't worry, over time, this becomes second nature. For now, just understand the pattern. Good economic news often means tighter money policy ahead, and that changes where money flows. Let's cover two more reports you'll come across. Retail sales. This measures how much people are actually spending in stores and online. Strong retail sales mean people are spending, which signals growth ahead. Weak retail sales mean people are pulling back, which can cause stocks to fall. Consumer confidence. This is basically a survey asking regular people how they feel about the economy. When confidence is high, people spend more and stocks tend to rise. When confidence is low, people hold back and money often flows into safe haven assets like gold instead. Here's the big takeaway from all of these reports. Markets don't just react to the number itself, they react to what that number suggests is coming next, in terms of interest rates, inflation, and overall growth. Let's make this real with one specific, very famous report. The US Jobs Report, often called NFP, which stands for Non-Farm Payrolls. It comes out the first Friday of every month, and it genuinely moves markets within seconds of release. If the NFP report is strong, the dollar tends to rise because traders expect interest rates might go up. Stocks may dip slightly because higher rates mean tighter financial conditions. Gold may fall since less fear means less demand for a safe haven. And oil may actually rise because a strong economy means more energy demand. If the NFP report is weak, the dollar may fall because rate cuts become more likely. Stocks and gold may rise, anticipating support from the central bank. And oil may drop on fears of a slowing economy. Here's the one sentence I want you to remember from this entire lesson. Markets don't move on the number itself. They move on what that number means for the future. Now here's something that genuinely changed how I see the market once I understood it. When big news drops, you and I are not the ones reacting first. Who actually moves first? Hedge funds, central banks, investment banks, large asset managers. These are companies managing billions, sometimes trillions of dollars. They react instantly to economic data, to speeches from central bank officials, to wars and political events, to oil supply news. By the time you and I see the candle move on our charts, these institutions have often already placed their trades. So here's the most important mindset shift I can give you today. Retail traders, that's us, don't need to be faster than institutions. We genuinely can't be. What we need to be is smarter. We need to understand why the move is happening so we can react with logic, not panic. Beyond economic reports, there are bigger global forces that shake the market too. War creates fear. And fear usually sends gold and the dollar up, while stocks fall, because investors run towards safety. Trade wars between countries weaken exports, which can push stocks down, gold up, and cause currencies to shift based on investor confidence. Oil supply disruptions, say a major oil-producing country has a conflict, cause oil prices to spike, which creates inflation pressure, which can then trigger central bank action. And natural disasters, pandemics, or political unrest create general instability, often leading to sudden policy changes. The big lesson here: everything is connected. News, commodities, interest rates, and how investors are feeling emotionally, they're all part of the same web. So let's bring this all the way back to you, sitting in front of your charts. What does any of this actually mean for your trading? Central banks change the rules constantly through interest rates and policy decisions. News and global events shape how people feel about the market, which drives buying and selling. Money is always moving between currencies, stocks, gold, and oil based on where risk and reward look best. And the chart you're staring at right now shows you the result. But the real reason behind that candle happened somewhere else, often hours or days before. Here's what I want you to take away. You're not just trading lines on a chart. You're reacting to the real world. Economics, politics, human emotion, all compressed into a single moving price. Once you start seeing the market this way, trading starts to feel a lot less random. And that's lesson 2 complete. You now understand how the global financial system actually works, how trade, companies, inflation, central banks, and global events all connect to move the markets you trade every single day. In our next lesson, we're going to bring this down to the charts themselves and talk about how price really moves. If this lesson made things click for you, hit like and subscribe so you don't miss lesson 3. And if anything wasn't clear, drop it in the comments. I genuinely read every one and I'll answer you directly. See you in the next lesson.